Hey guys, welcome back to Andrew Invests. I hope you had a wonderful Christmas. I'm celebrating the end of the year in New York, and I've had a few thoughts about my investment strategy and performance for 2023. We closed out the year with around $35,000 in profit, or a 35% return. Overall, we're only sitting at around a 19% return because of 2022. But overall, I'm pretty happy about the performance, and most of it has been driven by my individual stock portfolio. Anybody who buys stocks knows that the goal is to beat the S&P 500 or the market, or at least match it. And I'm happy to report that my individual stocks this year doubled the performance of the S&P 500, so I'm pretty pleased with that. But a lot of people say that it's impossible to beat the market in the long term. And I actually used to subscribe to that vein of thought, but I've since changed my mind.
What is the efficient market hypothesis? The main idea behind the hypothesis is that the prices of traded assets, such as stocks, already reflect all publicly available information. And thus, if you're investing based on publicly available information, you won't be able to systematically outperform the market over time.
The efficient market hypothesis states that all information is priced into every stock's price at any given moment in time, which means that everything is fairly priced based on the information available, and that would mean it's impossible to beat the market and buy stocks at undervalued or overvalued prices. So if that is truly the case, then how do you get cases like Meta being priced at a third of its current price at the end of 2022 and allowing investors to make 200% returns on it? Well, it's simply absolute nonsense. The market trades on human emotion. Not everyone trades based on the data available, and most people just trade on how everyone else feels about a stock. Meta's huge rally this year represents vindication for people who are able to ignore the media doom and gloom surrounding the stock and buy anyway. Take any Bloomberg article from the end of 2022 or online discussion, and you'll see that everyone was saying that TikTok would take almost all of Meta's market share away, the stock price would go to zero, and so on. But if you actually look in 2023, TikTok is actually growing slower than Instagram and Facebook. Another company which had a very similar narrative around it at the end of 2022 was Netflix. Everyone was saying that their proposed crackdown on password sharing would completely crater their subscriber numbers, alongside the massive competition from legacy media in streaming like Paramount Plus, HBO Max, and so on, would completely destroy the company's subscriber numbers and revenue. And that was reflected in the share price. Looking back, I wish I had ignored the doom and gloom and bought more Netflix stock, but instead I just held. That was a mistake. Take Netflix's password sharing crackdown. Rather than decreasing subscriber numbers and making people cancel, plenty more people actually subscribed, and Netflix's subscriber numbers absolutely spiked during that period. Its price increases also did nothing to reduce its subscriber numbers, and those have still been steadily growing. Netflix is now the only profitable streaming company, and that says a lot. Take a look at its competition. HBO, Discovery, Paramount, and Disney. They're all heavily indebted, paying out huge amounts of money to start their streaming services. They've now all started leasing their IP back to Netflix, which they promised they wouldn't do previously. And they still have to contend with their declining legacy media businesses. It's looking really tough. I personally see a consolidation of streaming, and Netflix is going to be one of the big winners. A stock which I think does have a similar narrative right now is Google. Now, Google has rallied a massive amount this year, nearly 60%, but I do think that the price is still relatively cheap. If you look at its forward price to earnings ratio, it's one of the cheapest out of all the tech companies. And that's because of one, all of the legal problems surrounding the company, and two, because people are worried that Microsoft and ChatGPT, or just AI LLMs in general, will replace the search engine function entirely, similarly to how people thought that TikTok would make Meta's apps redundant. Now, I personally think that those fears are very overblown and that it potentially represents a good buying opportunity for the company. Let's move on to the mistakes that I've made with my investment strategy over the last year. I'll be brutally honest because I want to learn and improve, and I want to help you guys do the same. So, something I've criticized other value investors for this year has been buying purely based on valuation and not the fundamentals and story of a company. I think it's really easy to see a cheaply valued company with a low price to earnings ratio and buy based purely on that. If you go grocery shopping and see an item that has a 90% sale, I think a lot of people will see it and buy it based on the valuation entirely. And it's the same with investing too. Take Alibaba. It has an extremely low price to earnings ratio and it's very cheap. But if you go into a store and an item's on 90% sale, there's probably a reason for that. Either the quality isn't very good or the item's gone out of fashion and nobody needs it. And it's the same with Alibaba. When you look at the risks surrounding the company or the quality of the company, they're murky at best, with the China issue taking center stage and the investment not being as good as what it might seem like on paper. When you look at some of the investments of mine that underperformed the market 24% this year, you can see that they're the investments that I bought mostly because of the valuation and not the long-term story of the company. Now, those companies are probably Alibaba and Crocs, as well as UK FTSE 100 ETFs. And I have a lot to say about that too. Having further researched Crocs, I do think it is the exception here as the company is still growing its revenues. I do think that the story is still good and I'm going to hold on to it. But with Alibaba, I'm planning to probably take some losses for tax reasons next year and reinvest the money into stocks that I think have a better growth story. My FTSE 100 holdings have underperformed the market this year, and that doesn't really come as a surprise to me. When I originally bought them, I was relatively inexperienced as an investor. It was 2020, just after COVID, and there were loads of articles saying how cheap UK stocks are. Now, they have gone up significantly since then, but take a look at all of the articles saying the exact same thing, that UK stocks are cheap and that you should buy now. Well, I personally don't believe that UK stocks are ever going to not be cheap, at least in the short term to medium term. Because UK stocks are cheap for a reason. Their quality is poor. Most of the companies in the FTSE 100 are from very old school industries like pharmaceuticals, mining, cigarette companies, and so on. These aren't the kind of companies that will have high growth rates in the future, and that's why their price to earnings ratios are so low or why they're so cheap. People say that US stocks are very expensive, but the reason they're expensive is because they have extremely high growth rates when compared to companies from other parts of the world. And ultimately, growth rates are going to be what drives share prices. So that's why I am planning to sell all of my UK holdings this year. In fact, I'm going to be selling all of my ETFs for other reasons, but I'm planning to buy Berkshire as a substitute S&P 500 ETF in the meantime, whilst I look for individual stocks to buy into. With regards to the FTSE 100 being of low quality companies, I think it's telling that any company that is growing at a high rate in the UK ends up listing in the US or transferring their listing from London to the US. For example, ARM decided to list in New York without even a secondary listing in London, despite being the UK's most successful tech company. And Ferguson, a plumbing company, transferred its listing to the US a few years ago and has done great since then. That's why the FTSE 100 is composed of low quality companies. I think the US is the best place in the world to invest. The attitude towards capitalism and allowing companies to make profit for shareholders, and there's no penalty for success in the US either. In Europe, I don't think that is the case. We've seen banks, oil companies, energy companies all face levies within the last few years for having successful years. As an investor, that's not something you want, and that's why I'm almost all invested into US companies. Last of all, in 2024, I want to buy companies with high growth rates, but sustainable ones. And I don't want to be put off by valuation that much or a high price to earnings ratio. Ultimately, a high price to earnings ratio means nothing in the long term if a growth rate can be sustained for a long time as well. A company can still be cheap with a high price to earnings ratio, and I don't want to be put off from quality companies because of that in the future. So those are the main things that I've learned in 2023 about investing. I hope that you guys have had a great 2023 as well. Let me know what you guys think in the comments below about my thoughts, and I'll see you guys next time.